Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore, and I am here with two of the best people I know. Lots of fun each week on the show. That's Jim Margraf and Josh LaTour at LaTour Asset Management, LLC. You guys are great to do the financial advice show each week, educate our listeners and folks in the community, let them know what's going on out there in the world of finance, things we need to know about, and today will be no exception. I am looking forward to the topic and the show today. However, first, I must ask, as I always do, Josh, I know this is a busy time of year for you guys, but you guys are always busy. What's going on? By the way, Josh, I don't know if those are new glasses or new haircut. You look very studious, very official today, like a professor or something.
Well, they say you got to fake it till you make it. So that's what I'm trying to do here, Tony. But
it looks like you're going to give a TED talk or something. You look
right.
pretty.
Well, I should wear glasses all the time, but I can get away without wearing them.
Sure.
So I'm just not good at making myself do it. But it's been rainy a lot recently. So when I'm driving in the rain, I've got an astigmatism, and it doesn't look good when I'm looking out the windshield and it's covered in water. I can barely see. So these help a whole lot. So I'm trying to be responsible.
Yeah. No, that's good. That's good. I guess that's really good. Yeah. You should probably wear them all the time. I mean,
I should.
If your goal is to make yourself look smarter than Jim and I, it's working. It's working.
I try.
It's not the only thing that's making you look smarter than me, at least. But
Tony, maybe you should get your glasses checked.
I need to buy some more professorial looking glasses, I guess. Yeah, threw that word out there. I got a quarter here for that word. But but you've been busy?
Very much so. Yeah. I mean, it's a buzzing time of year in our office.
Sure.
It's not as crazy for Jim and myself, although we've definitely been plenty busy. But it's Medicare season. And so we have a lot of Medicare clients, a lot of people coming in to meet with the ladies that take care of that. I believe last count, it was like roughly 900 appointments between our three offices.
That is insane.
Our three Medicare professionals in our two offices, rather.
Yeah.
But, it's a crazy time of year, but they're getting through it.
900 appointments in 7 weeks, right?
Yes.
Yeah. That's a lot.
That's a lot. Only until December 7th, right? I mean, then it's,
That's right.
It's locked in. So you've got to get that taken care of. And I think everyone should review their healthcare options. And if they're already in retirement, their Medicare options once a year anyway. And now is the time. But hopefully you've already booked an appointment, because it's a little late now. Any Medicare specialists out there are probably booked solid. So that's it. And then it leads right into tax season. So I know that the financial world stays busy for a while. There's a little break over the holidays, and then it kicks right back into gear.
It does.
So Jim, what have you been doing with all your extra time?
All my extra time. I had 10 seconds earlier? No. No, actually, we're enjoying finally some fall weather here in Missouri. It finally cooled off. You can walk outside, and you don't need shorts and t-shirt now.
Right.
So I think the high is in the 50s right now. So it's a lot nicer than it has been. So enjoying the cooler weather. And we also got some very much needed rain. It's been raining for the past few days here. And all the farmers around us are very grateful that we're getting that rain, because it had been very dry for way too long. So glad to see the rain.
Yeah, there you go. And I know, I mean, my dad still owns the farm that he grew up on and I grew up on, and the guy who's farming it now for us is a great guy. But earlier in the year it was like, but now they've had they've already got the crops out, and it was a pretty good year as far as crops.
Nice. Great.
Just need better prices so they can actually sell them. Prices have been pretty low for corn and soybeans. Anyway, it's not the ag report. What are we talking about here? This is a financial show, not the ag report. So,
well, it's the life a lot of our clients live. As farmers around here, a lot of cattle.
Yeah.
And so the how well how much rain we get, how well the fields are growing, all matters. Matters a
Yeah.
lot to them. So
of course
very
it does.
important.
Yeah, not as much cattle in the area I grew up. Mostly corn and soybeans, just flat and corn and soybean fields for miles. But they do have. Where I grew up. There was a hog. My grandfather raised hogs, and my cousin and her husband still raise. They have about 1,000 head of cattle. And it's sold for Angus beef. Yeah.
Nice.
Black Angus beef. So I always go, when I go down there to visit my parents, they live right by where my parents now live in long-term care. So I always stop in there and enjoy the flies on a cattle farm. It's just like I open the door. Hey, my vehicle's full of 100 flies, and all the way back to the Twin City, I'm rolling down windows to get the flies out. But I love seeing the cows. They're great. So today you guys wanted to talk about withdrawal strategies to what did you say? Withdrawal strategies to help?
Make your money last.
That's what we want to do. Make our money last. We don't want our bank account to hit zero before our blood pressure does, right?
That is always correct.
Our old buddy Tom Lowry used to tell me that. Tony, you don't want your bank account to hit zero before your blood pressure.
There you go.
The first time a couple times he said, I'm like, what is he talking about? And then I'm like, oh yeah, we don't want to run out of money in retirement. Yeah. So how can what do withdrawal strategies have to do with this? And what's the first tip you have for us?
Well, I think the big thing, Tony, is for so many people, they've spent their entire life saving and they get to retirement and they go, oh, wait, now I'm supposed to take money back out of this account that I've been putting money into my entire life. How do I do that? And it's a scary thought. And people, a lot of times they get really nervous about the whole idea and because they don't want to do it wrong.
Right.
And they don't want to, obviously, as we were just saying, they don't want to run out of money before they run out of life. So, but we also don't want to live with our back up against the wall and not live, right? And not enjoy life.
Right.
So how do we do this in a way to live the lifestyle that we want? And there's a lot of withdrawal strategies that are out there. There's several that we want to talk about today. But then we want to, I think, end with what we do here at LaTour and how we help our clients withdraw from those retirement accounts in a way that makes sure that their money lasts as long as they do.
Sure. Yeah, that sounds good. Okay, what's the first withdrawal strategy you want to touch on then?
Well, Tony, there's the old classic, the 4% rule. And we've talked about it on this show time and time again. And we've talked about how, I mean, it's not the worst thing in the world, but there are shortcomings to it. And I honestly think that most of the strategies we're going to talk about, they have some merit, but they do have shortcomings and they're not complete. But the 4% rule, basically it says that you can take 4% out of your investments as long as you have the right structure of investments, the right amount of risk versus safety in your portfolio, and it will last you for 30 years in retirement. And honestly, it worked pretty well back in the last century and back in the 80s, 90s, early 2000s is where it started getting a little rocky because we had some recessions that hit. We had back-to-back recessions in the early 2000s.
Right.
And that really, it messed up this whole strategy.
Sure.
And mainly because the rule of thumb was that you have the right mix of stocks and bonds, and the bonds were going to be safe enough that when the stocks went down, the bonds would help bolster it up. That didn't happen in the first two recessions of this century. So it didn't
happen in 2022 either, right?
No, it did not.
I mean, since then, bonds have been kind of
they've been going in tandem.
Down. Yeah,
it's been a problem.
So the old 60-40 rule and the 4% rule, those are two rules of thumb that have really suffered, is what you're saying.
Exactly. Yeah, and it worked okay in the years, after 2008, where the market just kind of went up for quite some time. I mean, at least 10 years before we really saw much of a downturn in 2018.
Right. Sure.
So, but the thing is, it's not necessarily set to weather the storms that we end up facing because recessions are just a part of life. We're going to have them. The economy, it's going to go through cycles. And so we want to make sure that our withdrawal strategy from our retirement funds is set to weather those storms.
Yeah.
And with some of the research that came out, there was a study that was done in coordination with Morningstar years ago that said that because of the back-to-back recessions that we had at the beginning of this century, that they recommended that we reduce the withdrawal percentage down to 2.8, which means if you're going to maintain that same standard of living, you have to have increased your net worth by quite a large margin. Right. And so there are some issues with the 4% rule, and it's a nice place to start, but we do need to fine tune some things to get them working for you and your situation, your goals, your objectives. But again, it has a few issues.
Yeah, it sounds like it. And that's why you want to work with financial services professionals like yourself to make sure you customize it. If you just try to follow a rule of thumb just because that's what, someone else did, your situation's going to be different. And we live in different times. These rules change.
Sure. They do.
Yeah. So what's another strategy we need to know about?
Well, the next one would be the fixed dollar strategy. So the idea behind that one is we figure out at the beginning of retirement how much we think we can take out of our portfolio whether it's on a monthly basis or an annual basis, and take that amount out for the rest of our retirement years. The issue is, again, similar to what we have with the 4% rule, and that is that if we have a sizable market downturn, it doesn't adjust in any way for the market taking some of our funds from us. So there are some shortcomings. The problem is that if the market takes a bunch from us and we keep taking that same dollar amount out, we may run out of funds before we run out of life. Yeah. And so someone that is following either the 4% rule or the fixed dollar strategy, they're going to have to make adjustments along the way to how much they're taking out depending on market conditions. So you're going to have to be paying attention throughout your retirement to the trends and what's happening in the market, because you're going to have to adjust how much you're taking out.
Sure. And I want to talk about one of the ways that this can be used that can actually work. Again, like we said, these are not bad systems, but they're just not complete.
Yeah.
I have a client that I just met with today who wants to wait a couple years before she turns on her Social Security. Well, we're going to use the fixed dollar strategy to bridge that 2-year gap before she turns on her Social Security. Yeah. She needs a certain amount a month. Once she gets to Social Security age, then that's going to replace what she's needing to pull out. So it's going to work for her because she doesn't need to necessarily do that for the rest of her life. So that in this particular case, that works. And maybe it needs to be adjusted along the way. Maybe we don't stay with the same dollar amount the entire time. But that's basically where we're starting.
But for your client, that's a short-term strategy.
Exactly.
It's not a rest of your life strategy where you're taking that same dollar amount out for the rest of your life. So it works, and it works very well for her.
Exactly.
Yeah. So the benefit of this fixed dollar strategy would be, hey, I get a predictable annual income. I'm taking out. I know I'm going to take out this much. The downside is inflation and market changes are two big negatives that can affect it, just like the 4% rule is what you're saying.
Exactly. But, we've talked about maximizing Social Security before, and that's exactly what my client is trying to achieve. She wants to make sure her Social Security has gotten to the maximum point where it makes the most sense for her to draw it. And so we're using some of her funds to help bridge that gap through these maximization years.
So I would say if you're going to use the fixed dollar strategy, the reasonable thing to do would be to regularly look at it and review it, right? With a financial professional. So make adjustments. Maybe at that once a year meeting with your financial advisor, you look at that. Okay, so the 4% rule and fixed dollar strategy. I haven't heard one that's ideal yet, and maybe they all have pluses and minuses. But yeah, with market volatility and inflation, you have to account for that, and I know that's what you guys do for your clients. Now, what's the third withdrawal strategy for retirement income that you have for us?
Well, the next one that we're going to look at is what we call the total return strategy. This is where someone wants to stay fully invested. they want their funds invested the way they have been for their working life. Okay, so they're a little more aggressive, and maybe they pull out enough to last them for the next 6 months or a year or something like that, so that they don't have the next year's income being influenced by the market. So they go ahead, they pull it out. Maybe they put it into a high yield savings account or something like that, and then they draw from that for the next year. So by doing that, they leave their funds what you're hoping for is that the market does what it tends to do over time, and that is increase, but it doesn't take into account, again, some of the shortfalls that can happen or some of the recessions and some of the downturns that can happen. And the risk is on this one is that as you run out of those funds that you've already taken out, what do I do if the market is heading into a recession just as I'm needing to pull back out of it again?
Right. You need to, yeah. So in other words, once that 6 months or a year is up and you've spent that money or getting close, then you're like, okay, I need to take out another few months or a year's worth.
Right.
But what if it's 2022 and the market's down, or it's April of this year and the market's down 20% and you need money? Yeah, that would be, if you sell during market lows, that's not good.
I mean, from what I've heard, and I think everybody else has pretty much knows, the idea here is to buy when it's low and sell when it's high, and not the other way around.
Right.
And so this strategy does present us with problems where we might be forced to sell when the market's at a low point,
which is what you never want to do, but what the majority of people who try to do it on their own end up doing, right?
Yeah,
they end up buying high and selling low, and that's not good.
Yeah, and a lot of times it's because of emotion in their investing.
Sure.
So
Sure.
So let's talk about the next strategy, Tony. I think we need to keep moving here. The bucket strategy. Now, it's actually somewhat similar to the total return strategy in that maybe we pull out enough for 6 to 12 months of income, put that into a high yield savings account. So we're still making something on it, but we have full accessibility. We've got the safety built in from the FDIC insurance, but that's just one of the buckets.
Right.
And I actually like this one because I think that it's important to split up our money according to what that money's job is. What are we needing this particular group of money to do? And so in this case, we have bucket 1. That's for satisfying our short-term income. Bucket 2, that's going to be things that are just a little bit longer term, but still fairly short. Things that have some safety so that we're not having to worry like we were in the total return strategy. If the market downturn happens, what are we going to do with next year's income? So this is going to be things like bonds, maybe some CDs, maybe short-term annuities, things like that have some amount of safety, some element. Yeah, exactly. Yep. Fixed annuities, MYGAs. Something that has some element of safety, so we're not having to worry about market downturns taking away the next 2-3 years of income, but also have a little bit more growth potential. And then bucket 3, that's where things can be just a little bit more adventurous.
Right.
It's not for the next several years of income, so it can be a little bit more aggressively according to your risk tolerance as an investor, be a little bit more aggressively invested. And so you can have more upside. And then if the downturns happen, as they will at times, it's not going to affect your need for income over the next couple years. So kind of splitting things up according to the job that it's supposed to do. I like that a lot.
Yeah, that's the first strategy we've talked about where it really helps protect against market volatility.
Right.
Yeah.
And, here's another one, though. With this, we still are going to have to make adjustments over time because we're going to be taking funds from that bucket that's more aggressive and moving it into the I'll call it the midterm bucket. And then from there, we're going to be moving some into the short term. And so we're going to be moving funds, over time. So we're still going to be continually adjusting how much is in each of those buckets as we go over time because we're spending out of that short-term bucket, right? So we're going to empty that one. So we're going to have to replace it over time. So it still is one that's going to require constant management.
Yeah.
But it does offer a little bit more protection for us than some of the other rules do.
So the downside, or really the action item more than a downside, is to regularly rebalance the buckets.
Right.
Yep.
Yep.
And I think
that's where you guys come in. I mean, it's not like that's the individuals. They have to sit there and once a month go through their overall plan. You guys are there to help them rebalance the budget and meet with them a couple times a year to do that. Yeah.
Exactly, Tony. And I think it's important anyway. I mean, you want to have a plan that is somewhat fluid, that because there's going to be different needs that arise along throughout your retirement. So you want to make sure that the plan is able to morph and move with your life, your lifestyle, and your needs. So I think that's just a good thing. The rebalancing of it all should just be part of any plan, really.
Yeah, I like the bucket strategy. And you can even, away from that, the type of money you have, you can have a tax-free bucket and you can have a taxable bucket. Yeah, I've always liked the bucket strategy. That seems to be a good one. What's the next one?
Well, Tony, I think the next one we want to look at is what we typically end up doing for our clients.
So your strategy.
So this is, we're going to call
LaTour
this
strategy.
The LaTour strategy. There you go.
Good.
So it's going to be a little bit of a version of the bucket strategy.
Right.
Because what we're going to do is we're going to start with, what do we need to have coming in, right? What do we need to have coming in on a monthly basis to sustain our standard of living? Then we're going to look and see what streams of income do we have coming in. So what, Social Security, do I have pension? Do I have rentals? What are those streams that I have? Then we're going to look and say, well, is there a gap between what I need to have coming in and what I actually do have coming in on that basis from Social Security and pensions and things like that? Then we're going to go and we're going to look at the assets that we've accumulated over time. So the retirement accounts, the IRAs, the 401ks, savings, we're going to take a look at those. And we're going to position enough of those dollars to help fill that income gap that we have, so that our income isn't going to be subject to the volatility of Wall Street.
Right.
And I think that is really, really important. We don't want our income subject to the volatility of Wall Street. And we're going to position those funds so that they're going to last as long as we do.
Yeah, and that's where, the 4% rule, that's where it falls short. I mean, you are subject to whatever the volatility is and what you're pulling from. If you're taking a percentage and all of a sudden you have a 40% downturn, well, now you're taking 4% of much, much less money. So you don't want your income on this roller coaster.
Right. Yeah, and I like that. You start with, here's what I'm going to need each month in retirement. And you factor in for things like inflation, things like market volatility. You have some that are principal protected, so you don't need to worry about that. You have some that is in growth. And, you try to maximize in each of those areas or buckets the growth any chance you get, of course. I like that. Obviously, you've helped so many people with that over the years. But again, everybody's situation is different, which is why before you make an individual plan for someone, you need to meet with them, get to know them, see where they're at currently. They need to take a risk analysis assessment to figure out where they're at, right?
Right. So we're going to go, as you mentioned, that risk assessment. We're going to go through what we call our color of money risk analysis. And you say, why do you guys call it the color of money? Well, because we're going to color code different groups of dollars according to risk. So we have what we call our green dollars. So those are funds that don't have the market risk on them. We have some type of a guarantee on those funds. It's not an absolute guarantee, because as we all know, the only absolute guarantees in life are what? Death and taxes, right?
And pizza. So, in my life, pizza is pretty much guaranteed.
Sorry,
Death,
I forgot.
Taxes, and pizza.
Three. There you go. Okay.
Hopefully not exactly in that order.
Yeah. Reverse that. Yeah.
So pizza first. So once we want to use that green bucket to fill that income gap, right? So that way we don't have the volatility on our income. Sure. Once we've satisfied that, though, now we're going to take the remainder of our funds and we're going to position it according to our risk tolerance, according to our goals, our objectives, and we're going to position it in what we would call cushion funds. Now, these are funds that, hey, the market can go through its cycles and affect these dollars, but we're, again, looking for some growth on those.
So what color is that?
We're going to color code that yellow.
Okay. For me, yellow always meant go faster. Am I right? If we're doing red, yellow, green, doesn't a yellow? What does a yellow light mean? Go faster? I mean, I may have gotten that one wrong on my drive.
Proceed with caution.
Right. Oh, okay.
We need to.
It doesn't mean speed up when the light turns yellow.
Not quite, Tony.
Okay. All right. I got that one wrong. Okay.
So we're going to proceed with some caution because we are going to take some risk with these dollars, right? So we want to have some professional management on these dollars because we're going to let them be affected by the market cycles. But for the amount of risk that we're taking, we want to get a nice reward, right? So these funds can go through market cycles. I may not need to draw from them, but should life happen and I do need to draw from those, it is available. Or hey, let's say I want to take the family to Disney. Then we have some funds that we can pull from to do that.
Yep. All right. Well, hey, we're running out of time. If you want to tick off a couple more considerations, just briefly list them and then wrap it up by letting our listeners know the bottom line and how to get a hold of you.
Well, Tony, I like how you mentioned the potential for a tax bucket, and I think that's an important part of an overall strategy, at least the consideration of a tax-free bucket, because that's a huge thing in income, because it's not just about what you make in retirement, but it's about what you're able to keep. And so definitely something to tack on as another consideration for an overall income strategy. But listeners, if you need an income strategy for your retirement, feel free, please give us a call. Our number is 417-641-3497. Our website is LaTourAsset.com.
All right. Great show today. A lot of great information. Listeners and viewers, thanks for tuning in. That does it for today's episode of LaTour Retirement Talk with our hosts, Jim Margraf and Josh LaTour.